Before we begin, a quick and important disclaimer. The following content is focused on the mathematics and historical structures of divorce insurance and domestic risk mitigation in the United States. This video is intended strictly for educational and entertainment purposes and does not constitute financial, legal, or insurance advice. Every individual's legal and financial situation is unique, and laws regarding marriage and insurance vary significantly by state. You should conduct your own due diligence and consult with a licensed professional, such as a family law attorney or a certified financial planner, before making any decisions related to your personal finances or marital contracts. Half of every dream in America is built on a statistical coin flip. Right now in the United States, a marriage ends every 36 seconds. That is 2,400 divorces a day, nearly 17,000 a week, and approximately 876,000 every single year. But while we insure our cars against a 1 in 50 chance of an accident, and we insure our homes against a 1 in 300 chance of a fire, we often leave the most significant financial contract of our lives, marriage, completely unhedged. Imagine a financial instrument where you pay a monthly premium, and if that coin flip lands on the wrong side, you receive a tax-free cash settlement to cover legal fees, alimony, and the massive cost of setting up a second household. This isn't a fantasy. It is a complex mathematical reality known as divorce insurance. Most people think a prenuptial agreement is the only way to protect their assets, but the math of the marriage casualty industry suggests there is a much deeper, more clinical way to view the end of a union. By the end of this deep dive, you will understand the actuarial tables that dictate these premiums, the probability of ruin that insurers calculate before they ever sign a policy, and the specific economic structures that determine whether your marriage is considered a high-risk asset in the eyes of a data scientist. To understand why this exists, we have to look at the sheer economic gravity of divorce. In the U.S., the average cost of a contested divorce ranges from $15,000 to over $100,000 when you factor in legal retainers, expert witnesses, and the division of commingled assets. For a middle-class couple, this represents a catastrophic liquidity event. Traditional insurance is built on the principle of indemnification, restoring the insured to the financial state they were in before the loss occurred. In the context of divorce insurance, often referred to in the industry as marital settlement agreement insurance or casualty loss coverage, the loss is the dissolution of the legal partnership. Let's break down the primary mathematical engine behind these policies: the waiting period and the benefit units. In most historical models of divorce insurance, such as those pioneered by firms like Safeguard Guarantee, you don't just buy a policy and get a check. The math is designed to prevent adverse selection. This is a term in insurance where people who know they are about to suffer a loss are the only ones buying the product. To counter this, divorce insurance typically utilizes a vesting period. For example, a policy might require a 48-month waiting period before any claim can be filed. This ensures that the policyholder isn't simply buying the insurance because they are planning a divorce next month. The calculation of the premium is where the math becomes incredibly dense. Actuaries look at a variety of data points to determine the burn rate of a marriage. They look at the age of the participants at the time of the wedding, the geographic location, as some states have higher no-fault divorce rates than others, and even educational backgrounds. Statistically, according to historical trends, couples who marry after the age of 25 have a lower probability of claim than those who marry younger. An insurer might calculate a premium based on units of coverage. Let's say one unit equals $1,250 of initial coverage. For a premium of $16 per month, you buy one unit. However, the math isn't linear. Most of these policies involve incremental growth. Every year you remain married and keep the policy active, the value of that unit might increase by $250. Take a case study of a policyholder who pays $160 per month for 10 units of coverage. After 5 years, their base coverage of $12,500 has grown through annual additions to perhaps $25,000. If the divorce occurs in year 6, the insurer is effectively paying out a lump sum claim that serves as a financial bridge. This isn't meant to make a profit. It is meant to mitigate the transition costs. These costs include the security deposit on a new apartment, the cost of moving, and the initial legal retainer for an attorney. When you look at the math of standard deviation in household income, a divorce usually results in a 25% to 40% drop in standard of living for both parties. Divorce insurance is designed to flatten that curve. We must also analyze the concept of moral hazard. In the world of economics, a moral hazard occurs when someone takes more risks because they know they are protected. Critics of divorce insurance argue that having a policy might make it easier to leave a marriage. However, actuaries argue the opposite. They point to the sunk cost of the premiums. If a person has paid into a policy for 7 years and is only 3 years away from a massive increase in the benefit payout, the mathematical incentive might actually be to work on the marriage longer to maximize the potential payout if the dissolution is inevitable. It creates a weird clinical form of marital retention. Furthermore, the mathematics of divorce insurance must account for the legal environment factor. In the US, we have a mix of community property states and equitable distribution states. In a community property state like California or Texas, the math is a 50-50 split of all assets acquired during the marriage. In equitable distribution states, the court has more leeway to decide what is fair. This uncertainty is what makes the insurance model attractive. If you are in a state where a judge has high discretion, your financial exposure is volatile. Insurance at its core is the business of selling certainty. By paying a monthly premium, the policyholder is essentially capping their downside. To truly appreciate the depth of this mathematical field, we have to look at the probability of success over time. Data shows that the highest risk of divorce occurs between years 2 and 8 of a marriage. This is known as the honeymoon decay period in actuarial circles. If a marriage survives past year 15, the statistical likelihood of divorce drops significantly. Therefore, the most efficient divorce insurance models are front-loaded. The premiums are highest or the waiting periods are most stringent during those first 8 years. Consider the opportunity cost of the premium itself. If a couple takes that $160 a month and puts it into a diversified S&P 500 index fund instead of a divorce insurance policy, they are betting on their own success. If they stay together for 20 years, that divorce fund could grow into a significant retirement asset. However, if they divorce in year 4, that index fund might only have $8,000 in it, while the insurance policy might pay out $20,000. This is the risk-reward ratio that every modern American couple unknowingly navigates. We are going to calculate the exact break-even point, where insurance becomes mathematically superior to self-funding your own exit fund. And we will look at how the disappearance of traditional divorce insurance companies in the mid-2010s led to a new era of alimony protection and legal fee indemnity products that are currently used by the ultra-wealthy. This is about more than just money. It is about the quantification of the American heartbreak. To understand how the mathematics of heartbreak evolved into a sophisticated financial product, we have to look at the actuarial concept of the survival function. In 2026, data scientists aren't just looking at whether a marriage fails. They are looking at exactly when it is most likely to fail based on a concept called the hazard rate. Imagine a couple, Alex and Jordan, living in a high-cost area like Northern Virginia. They marry in their early 30s, both working high-pressure tech jobs. To an actuary, Alex and Jordan aren't just people. They are a set of variables in a Cox proportional hazards model. This mathematical framework allows insurers to estimate the risk of an event, in this case divorce, occurring at a specific point in time, given that it hasn't occurred yet. The hazard rate for American marriages traditionally peaks between years 3 and 7. This is often referred to as the 7-year itch, but the data suggests it is actually a measurable increase in the probability of claim. If an insurance company were to offer a policy without a waiting period, the adverse selection risk would be astronomical. The insurer would essentially be selling $1 for 90 cents to everyone who already knows their marriage is failing. This is why the mechanics of these policies are built on the concept of the elimination period. In the context of divorce insurance, the elimination period is often decades long, or at least several years of continuous premium payments. Let's dive into the specifics of how a policy is priced using the law of large numbers. This principle states that as the number of identically distributed, randomly generated variables increases, their sample mean approaches the theoretical mean. For an insurer to be profitable while providing a benefit to the policyholder, they need a massive pool of married couples. If the pool is too small, one high-value divorce settlement could bankrupt the fund. In the 2010s, early attempts at divorce insurance failed not because the idea was bad, but because the risk pools were too concentrated with high-risk individuals. Today, the math has shifted toward a more sustainable derivative model. Imagine if Alex and Jordan decided to allocate a portion of their monthly budget to a marital casualty policy. The premium isn't just a random number. It is calculated based on the net present value of a potential future payout. If the policy offers a benefit of $50,000 to cover legal fees and relocation, and the historical trend suggests a 40% chance of divorce within 15 years for their demographic, the actuary must ensure that the total premiums collected, plus the interest earned on those premiums in the market, exceed the $50,000 payout multiplied by the 0.4 probability. Historical trends show us that the financial devastation of divorce is not equally distributed. We have to look at the concept of the feminization of poverty and the wealth gap created by domestic dissolution. For many years, the mathematical burden of divorce fell disproportionately on the lower-earning spouse, which statistically was often the woman. Modern divorce insurance math attempts to address this through a supplemental income rider. This is a specific add-on where the policy pays out a monthly stipend for a fixed period, say 24 months, following the final decree. This isn't alimony. It is an insurance indemnity. Think about the math of a typical American household's balance sheet. When you are married, your fixed costs like rent, utilities, and insurance are shared. Upon divorce, those fixed costs don't split in half, they double. 2 apartments cost more than 1 house. 2 utility bills cost more than 1. This is known as the economies of scale loss. If Alex and Jordan spend $4,000 a month on joint living expenses, after a divorce, they might each spend $3,000. That $2,000 monthly deficit is the structural hole that divorce insurance is mathematically designed to fill. But why did the first iterations of this product, like the famous wedlock policies, struggle to gain mass market traction? It comes down to the pricing elasticity of demand. Most people are optimism biased. On their wedding day, 100% of couples believe they are in the 50% that will stay together. From a behavioral economics perspective, it is incredibly difficult to sell a product to someone who believes their risk of needing it is 0. To counter this, newer financial products in 2026 are often bundled into broader family protection plans or high-net-worth wealth management strategies. Let's examine a case study of a legal fee indemnity product. In a high-stakes divorce, the legal fees can spiral due to discovery, depositions, and forensic accounting. A standard retainer might be $10,000, but the total bill could reach $80,000. An indemnity policy functions like a stop-loss mechanism. Once the policyholder spends a certain amount of their own money, the deductible, the insurance kicks in to cover the remaining legal costs up to a certain limit. The math here is similar to medical necessity in health insurance. The insurer will only pay for reasonable and customary legal fees. This prevents the policyholder from hiring the most expensive attorney in the country just because the insurance is picking up the tab. This leads us to the intersection of insurance and the prenuptial agreement. Many people think these are the same thing, but the mathematics are fundamentally different. A prenup is a contract that dictates how existing and future assets are divided. It is a zero-sum game. What one person keeps, the other loses. Divorce insurance, however, is a positive-sum addition to the equation. It brings new capital into the situation that didn't exist before. It's the difference between fighting over how to slice a shrinking pie and having an insurance company bring a second pie to the table. In 2026, we are seeing the rise of parametric divorce insurance. This is a fascinating mathematical evolution. Traditional insurance requires a long claims adjustment process where you prove your losses. Parametric insurance, however, pays out based on a specific trigger. In this case, the trigger is the filing of a final decree of dissolution. The moment the court clocks that document, the payout is triggered automatically. This removes the friction costs of proving how much your lawyers cost or how much your lifestyle has depreciated. The payout is based on a pre-agreed formula. If we look at the historical data of the U.S. Census Bureau and the CDC's National Center for Health Statistics, we see that the duration of marriage follows a log-normal distribution. Most divorces happen relatively early, but there is a long tail of divorces that happen after 25 years, often called gray divorce. The math of ensuring a gray divorce is entirely different because it involves the valuation of pension funds, Social Security offsets, and the time value of money. If you are 60 years old and divorcing, you don't have the human capital or the remaining working years to recover your losses. This is where the mathematical probability of ruin becomes most terrifying. But what if the math could do more than just pay out after the crash? What if the data could predict the crash before it happens? As we move into the next phase of this masterclass, we have to look at the predictive analytics that modern insurers are using. They aren't just looking at your age and income anymore. They are looking at micro-behaviors. There are mathematical models now that claim to predict marital stability with over 90% accuracy based on communication patterns and financial stressors. If an insurance company knows with 90% certainty that a couple will divorce within 3 years, what does that do to the premium? And more importantly, what does it do to the insurability of the American family? We are entering an era where your marital credit score might be just as important as your FICO score. In the next part, we are going to tear apart the specific algorithms used to calculate these risk scores and show you the hidden variables that determine the price of your protection. We will look at how the cost of conflict is being quantified in ways that would make a courtroom judge blush. Stay tuned because the math gets much darker from here. The quantification of conflict is not just a theoretical exercise for academic sociologists anymore. In 2026, it is a line item in the risk management software used by major financial institutions. To understand how an insurer determines your marital credit score, we have to look at the Gottman method through the lens of Bayesian probability. Dr. John Gottman famously claimed to predict divorce with over 90% accuracy by observing just 15 minutes of a couple's disagreement. In a world of big data, insurance companies have taken those behavioral markers, specifically the 4 horsemen of criticism, contempt, defensiveness, and stonewalling, and translated them into digital footprints. Imagine a character named Marcus, a software engineer in Austin, Texas. Marcus is 38, married to Sarah, and they have 2 children. When Marcus applies for a high-limit marital indemnity policy, the insurer doesn't just look at his income. They look at the correlation between financial volatility and domestic friction. They analyze historical trends that show a direct mathematical link between a sudden 20% drop in household liquidity and a 15% spike in the probability of a divorce filing within the following 18 months. This is known as the financial stress coefficient. If Marcus has a high debt-to-income ratio, even if he has never missed a payment, his premium for divorce insurance will be higher than someone with a lower ratio, because the math suggests he has less of a buffer to absorb the shocks that lead to marital dissolution. The dark side of this math lies in the hidden variables of consumption. Actuaries have discovered that certain purchasing patterns are leading indicators of lifestyle changes that often precede a divorce. For instance, a sudden shift in discretionary spending, moving away from joint household utilities toward individual luxury services or solo travel, can be flagged as an increase in the individualization index. If the data shows that one spouse is beginning to decouple their financial identity from the household, the insurer views this as a precursor to a claim. It is the digital equivalent of seeing smoke before the fire. Let's get into the step-by-step details of the underwriting algorithm. When a firm assesses a couple like Marcus and Sarah, they utilize a weighted average of several key risk factors. First is the age difference variable. Historical trends indicate that marriages with an age gap of 10 years or more have a 39% higher likelihood of dissolution compared to couples born within 3 years of each other. This isn't a judgment, it's a data point. Second is the educational parity score. The math shows that when both partners have similar levels of education, the marriage has a higher statistical survival rate. Third, and perhaps most controversially, is the intergenerational divorce history. Actuaries have found that individuals whose parents divorced are statistically more likely to experience a divorce themselves. In the eyes of the insurer, this is a form of inherited risk, similar to a family history of heart disease in life insurance. Now, consider the concept of the opportunity cost of conflict. In 2026, we use a formula to calculate the total economic loss of a contested divorce, which we call the conflict multiplier. If Marcus and Sarah decide to divorce and it remains amicable, the cost might be a base of 1.0. However, if they enter litigation over child custody, valuation of Marcus's stock options, that multiplier can jump to 5.0 or 10.0. The insurance company's goal is to minimize this multiplier. Some modern policies actually include a mandatory mediation rider. This clause states that the insurance company will only pay the full benefit if the couple agrees to participate in third-party mediation before filing a formal lawsuit. The math is simple. A $5,000 mediation session can prevent a $50,000 legal bill. By forcing mediation, the insurer is protecting its own capital while simultaneously lowering the emotional and financial wreckage for the family. Step by step, the calculation of a premium for a 2026 policyholder looks like this. The insurer starts with the base rate, which is currently about 2% of the desired total benefit amount per year. If Marcus wants a $100,000 payout, his starting premium is $2,000 a year, or $166 a month. Then the underwriters apply the loadings. If he lives in a state with complex property division laws like New York, they add a 10% complexity surcharge. If his job is in a high divorce industry, statistically, professions with high travel requirements or irregular hours like pilots or healthcare workers, they add another 5%. Finally, they subtract the protective factors. If Marcus and Sarah have been married for more than 10 years, they might get a 15% longevity discount. If they own a home together, which acts as a stabilizing anchor, they get another 5% off. This brings us to the valuation of intangibles. How do you put a price tag on the loss of a stay-at-home parent's career trajectory? This is one of the most difficult mathematical problems in family law and insurance. In a divorce, the court often tries to calculate alimony based on the standard of living established during the marriage. Insurers use a different metric, the human capital depreciation model. If Sarah stepped away from her career as a marketing director for 8 years to raise their children, her market value has theoretically depreciated. The insurance policy might include a re-entry benefit, which provides a specific fund for Sarah to pursue an MBA or professional certifications to retool her human capital. The math here is focused on future earning potential, rather than past contributions. Wait, there is a deeper layer. We must discuss the liquidity trap of the middle class. The very wealthy can afford to lose 50% of their net worth and still maintain a high quality of life. The very poor often have fewer assets to litigate over. It is the middle class, the families with a $400,000 mortgage, 2 car notes, and a 401k, that face the greatest probability of ruin. For these families, a divorce is not just a change in relationship status. It is a mathematical reset to zero. Divorce insurance in 2026 is increasingly marketed as a middle-class safety net. But what happens when the math becomes a self-fulfilling prophecy? If Marcus knows he has a $100,000 check waiting for him the moment he signs the papers, does that change his behavior during a Tuesday night argument? This is the fundamental question of social engineering through financial products. We are seeing the emergence of incentive-based premiums. Imagine a policy where your monthly cost drops if you can prove you attended a marriage retreat or completed a financial literacy course with your spouse. The insurer is effectively betting that these interventions will lower the probability of a claim. However, there is an even more advanced mathematical strategy used by the top 1% that makes standard divorce insurance look like a toy. They don't just buy a policy. They create what is known as a domestic asset protection trust, or DAPT, combined with a captive insurance company. This allows them to essentially insure themselves and deduct the premiums as a business expense, creating a tax-efficient fortress around their wealth. In the next section, we are going to dive into these high-level shadow structures. We will look at how the ultra-wealthy use the math of the tax code to ensure that no matter what happens in the bedroom, the boardroom remains untouched. We are going to reveal the exact formulas used to value a spouse's non-monetary contribution, and how that valuation can be manipulated to either protect or liquidate a fortune. The complexity is about to double because in the world of high-finance divorce, the person with the best algorithm usually wins. To understand how the ultra-wealthy utilize these shadow structures, we must first analyze the internal mechanics of a captive insurance company. In the context of domestic risk, a captive is essentially a private insurance company created and owned by the very individuals or family offices it is designed to protect. Imagine a high-net-worth individual in 2026 named Robert, who manages a private equity fund in Greenwich, Connecticut. Robert recognizes that a standard divorce settlement could trigger a liquidation event, forcing him to sell shares of his fund at a suboptimal time, thereby eroding his long-term internal rate of return. Instead of buying a retail insurance policy, Robert's family office sets up a captive insurance entity. The math of a captive is driven by Section 831B of the Internal Revenue Code. Under this structure, the family business pays premiums to the captive to cover various risks, including marital dissolution or legal indemnity. These premiums are often tax-deductible for the business, and the captive itself can receive a certain amount of premium income each year tax-free. When the risk of divorce is quantified by an independent actuary, the premium is set at a level that reflects the actual historical trends of high-stakes litigation. If a divorce never happens, the capital stays within the family's broader financial ecosystem, growing through reinvestment. If a divorce does occur, the captive pays out the claim to cover the massive legal expenses or the specific settlement obligations, effectively using pre-tax dollars to fund the transition. This leads us to the valuation of the non-monetary contribution, which is perhaps the most contested variable in the mathematics of American divorce. In 2026, courts and insurers are increasingly using a replacement cost method to value the labor of a non-earning spouse. Let us look at the case study of a spouse who manages a high-profile household. The math isn't just about what it would cost to hire a nanny or a cook. It is a multi-factor calculation that includes the roles of a chief operating officer, a private concierge, an event coordinator, and a property manager. By calculating the market rate salary for each of these professional roles and applying a geographic cost of living adjustment, an actuary can arrive at a shadow salary. For a household in a Tier 1 city like New York or San Francisco, this shadow salary can easily exceed $250,000 per year. However, there is a second, more complex method called the opportunity cost valuation. This asks the question, what would the spouse have earned if they had stayed in the workforce? This involves calculating the compounded annual growth rate of their career prior to marriage and projecting it forward across the duration of the union. If a spouse left a law firm making $150,000 10 years ago, the math must account for the missed promotions, the lost equity partner distributions, and the erosion of professional networking capital. In 2026, insurance products are being built specifically to hedge this human capital erosion. These policies, often taken out by the lower-earning spouse at the beginning of the marriage, provide a payout that is mathematically linked to the delta between their current earning power and their projected earning power had they remained employed. Step by step, the math of this delta looks like this. First, the actuary determines the terminal value of the career at the time of the wedding. Second, they apply a standard inflation rate and a professional growth multiplier based on the specific industry, such as tech or finance. Third, they subtract the current market value of the spouse's skills. The resulting number is the insurable interest. If the gap is $2 million over a 20-year period, the premium is priced against that total liability. We must also examine the mathematical concept of commingling and its impact on insurance risk. In many states, separate property, assets owned before the marriage, can become marital property if they are mixed with joint funds. This is known as transmutation. Insurers look at the commingling frequency of a couple as a risk metric. If a couple maintains separate bank accounts and only uses a joint account for household expenses, their risk of a complex, multi-year legal battle is statistically lower. Consequently, their premiums for legal indemnity insurance are lower. In 2026, some high-end insurance companies provide policyholders with specialized software that tracks every transaction to ensure that separate property remains separate, mathematically reducing the litigation surface area. Now, let us consider the scenario of the gray divorce through the lens of pension valuation. For couples divorcing after age 55, the most significant asset is often a defined benefit plan or a 401k. The math here requires a qualified domestic relations order, or QDRO. The insurer's role in a gray divorce often involves a longevity hedge. If one spouse is slated to receive half of the other's pension, but the pension-holding spouse passes away early, the receiving spouse could lose their income stream. To mitigate this, specialized divorce insurance products incorporate a life insurance wrapper. The math ensures that the present value of the future pension payments is protected regardless of the mortality of the ex-spouse. We must also touch upon the cohabitation effect. In 2026, the mathematical definition of marriage is blurring with common law, or de facto partnerships. Many states are moving toward a model where long-term cohabitation triggers similar financial obligations to marriage. Insurers are responding by offering domestic partnership indemnity. The math for these policies is even more volatile because the trigger for a claim isn't a legal decree from a court, but a physical separation or the termination of a joint lease. This introduces a significant verification risk. How does the insurer know the relationship is actually over? To solve this, 2026 policies are using social proofing algorithms, which analyze public data and residency records to confirm the dissolution of the domestic unit before a claim is processed. Everything we have discussed so far assumes a world of visible assets in traditional accounts. But what happens when the math goes underground? In the world of high-stakes divorce, the concealment of assets is a major variable. In the next section, we are going to explore the mathematics of forensic accounting. We will look at how insurers and investigators use Benford's law to detect fraudulent financial statements, and how they use network analysis to find hidden offshore entities. We will dive into the probability of discovery, and how it dictates the settlement leverage in the final hours of a divorce negotiation. If you thought the premiums were high, wait until you see the cost of the digital manhunt used to find the money they don't want you to see. The hunt for the hidden delta is where the true masterclass begins. The mathematics of concealment begins with a principle known as Benford's Law, also called the first-digit law. In 2026, forensic accountants working for insurance companies use this to flag potential fraud in financial disclosures before a single subpoena is even issued. Benford's Law states that in many naturally occurring collections of numbers, the leading digit is likely to be small. For example, the number 1 appears as the leading digit about 30% of the time, while 9 appears less than 5% of the time. When a spouse, let's call him David, a real estate developer in Miami, attempts to fabricate expenses or hide income to lower his potential alimony obligations, he often chooses numbers that feel random to the human brain. However, the human brain is terrible at replicating true mathematical randomness. If David's ledger shows a disproportionate amount of expenses starting with the digits 7, 8, or 9, the software flags a high probability of manual manipulation. This is the first step in the digital manhunt, the mathematical smell test. Once a red flag is raised, the investigation moves into the realm of graph theory and network analysis. In 2026, money rarely disappears. It just changes its digital address. Forensic experts use a concept called link analysis to map out the connections between David, his business entities, and secondary shells. They look for the centrality of certain nodes. If a particular shell company in the Cayman Islands or a specific digital wallet address appears as a frequent bridge between David's personal accounts and his business accounts, the math identifies it as a high-interest node. By calculating the eigenvector centrality of these nodes, investigators can determine which accounts are merely noise and which ones are the critical junctions where wealth is being funneled. Let us examine a case study involving the valuation of private equity and stock options, which is a massive point of contention in modern American divorce. Imagine David's spouse, Maria, has a claim to a portion of his unvested shares in a startup. The math used here is the Black-Scholes model, a mathematical framework used to determine the fair price of stock options. However, in a divorce, we have to apply a co-ownership discount or a lack of marketability discount. If the stock is in a private company, you can't just sell it on the New York Stock Exchange tomorrow. Therefore, the math must account for the illiquidity risk. An actuary might apply a 20% to 30% haircut to the paper value of the shares to reflect the fact that they cannot be easily converted to cash. This leads to a fierce mathematical debate. David wants a high discount to keep more shares, while Maria wants a low discount to maximize her settlement value. Then there is the concept of double dipping, a mathematical error that occurs frequently in high-stakes settlements. Imagine David owns a professional practice like a surgical center. The court might value the business based on its future income stream. If the court then also orders David to pay alimony based on that same income stream, he is effectively being charged twice for the same dollar. Forensic accountants use a process called income normalization to prevent this. They strip away the one-time windfalls and the personal expenses run through the business, like David's car or travel, to find the true maintainable earnings of the entity. This normalization process involves a step-by-step audit of the last 5 years of tax returns, looking for outliers in the standard deviation of annual growth. But what happens when the assets aren't in a bank account? We are seeing a massive shift toward the tokenization of real estate and the use of decentralized finance or DeFi. In 2026, a spouse might hide wealth by providing liquidity to a decentralized protocol, or by purchasing fractionalized interests in commercial properties through a blockchain. Tracking this requires a specialized field called on-chain forensics. The math here involves analyzing the velocity of money through a specific wallet. If a wallet has a high turnover rate but a low ending balance, it suggests it is being used as a pass-through entity. The investigator uses a heuristic analysis to link that anonymous wallet to David's real-world identity, often by finding the one moment where he moved funds from a regulated, know-your-customer exchange into the private network. Now, let's talk about the mathematics of lifestyle analysis. This is often the most damning evidence in a divorce. If David claims his income is $150,000 a year, but his credit card statements and mortgage payments total $400,000 a year, the math doesn't balance. This is known as the cash flow imbalance formula. Forensic accountants perform a lifestyle audit, where they categorize every single dollar spent over a 36-month period. They look for the burn rate. If the burn rate exceeds the reported income, the burden of proof shifts to David to explain where the invisible capital is coming from. Historical trends show that in roughly 65% of high-net-worth divorces where a lifestyle audit is conducted, undisclosed income or assets are discovered. This brings us to the insurance for hidden asset recovery. This is a specialized, niche product available in 2026. If Maria suspects David is hiding millions, but doesn't have the $50,000 needed to hire a top-tier forensic team, she can purchase a forensic indemnity policy. The insurance company pays for the investigators and the legal fees to hunt for the money. In exchange, the insurer takes a percentage of any new assets discovered during the process. It is a mathematical hedge against the information asymmetry that exists in many marriages. The insurer isn't just betting on Maria. They are betting on the statistical likelihood that David, like most humans, left a digital breadcrumb trail. The final mathematical hurdle in this part is the tax impact calculation. Every dollar in a divorce is not created equal. A dollar in a 401k is a future tax liability dollar, while a dollar in a Roth IRA is a tax-free dollar, and a dollar in a checking account is a post-tax dollar. When dividing $1 million, if David takes the 401k and Maria takes the cash, Maria has actually won the mathematical battle by a margin of roughly 25%, depending on the current tax brackets. Actuaries use a tax-affecting formula to ensure that the final division of assets is truly equitable on an after-tax basis. They calculate the deferred tax liability of every single asset on the balance sheet, projecting what the tax rate will be when those assets are eventually liquidated years down the road. If you thought the hunt for hidden millions was complex, you haven't seen how the math handles the most emotional asset of all time. We are moving from the cold world of bank ledgers into the even more precise world of custody algorithms. In 2026, the standard of living isn't just about money. It's about the hours and minutes allocated to each parent, and there is a massive financial incentive tied to those numbers. In the next part, we are going to break down the mathematics of child support formulas and the parenting time offset. We will see how a single extra night a week can swing a child support payment by thousands of dollars a month, and how insurers are now offering custody litigation insurance to protect parents from the high cost of fighting for their time. The math is moving into the nursery, and the stakes are getting higher. The nursery is where the most rigid legal formulas in America meet the most emotional human realities. And in 2026, the intersection is governed by a concept known as the cliff effect. To understand child support, you have to understand that the United States does not have a single unified math problem for kids. It has 50 different algorithms, primarily falling into two camps: the income shares model and the percentage of income model. In the income shares model, used by the majority of states, the math begins with the assumption that the child should receive the same proportion of parental income that they would have received if the parents lived together. Imagine a couple in Denver, Colorado. Let us call them Michael and Elena. Michael earns $120,000 a year, and Elena earns $80,000. Their combined household income is $200,000. The state uses a basic support obligation table, which is a massive data set derived from historical trends of what an intact family at that income level spends on housing, food, and clothing. If the table says a $200,000 household spends $2,500 a month on one child, Michael is responsible for 60% of that, $1,500, because he earns 60% of the income. But here is where the math gets aggressive: the parenting time offset. In Colorado and many other jurisdictions, if Michael has the child for more than 92 overnights a year, he enters a shared physical care formula. This is the cliff. At 91 nights, he might pay the full $1,500. At 93 nights, the math shifts to a cross-credit formula where the child support amount drops significantly because the law assumes he is providing for the child's needs directly during his time. A single night, the 92nd night, can be worth thousands of dollars in annual cash flow. This creates a mathematical incentive for litigation that insurers have begun to quantify as custody risk. Custody litigation insurance, a product gaining traction in 2026, is built around the actuarial probability of a modification filing. Insurers know that as children age, the cost of their care increases, and the likelihood of a parent seeking to change the parenting schedule rises. The math for these policies involves calculating the mean time between filings. In high-conflict demographics, the data shows a modification request every 3.2 years. The policy acts as a prepaid legal fund, specifically designed to cover the experts needed to litigate these minutes: child custody evaluators, forensic psychologists, and parenting coordinators. Let us look at the step-by-step details of how an insurer calculates the risk of a custody battle. They look at the geographic distance variable. If Michael lives 5 miles from Elena, the risk of a schedule breakdown is low. If Michael moves 60 miles away for a new job, the math of the commute makes a 50-50th split physically impossible for a school-aged child. The insurer views this move as a trigger event. They apply a mobility multiplier to the premium. Historical trends indicate that a move of more than 50 miles increases the probability of a return to court by 400%. Furthermore, we must analyze the extraordinarily high income deviation. In many states, the standard child support tables stop at a certain income level, often around $30,000 or $40,000 of combined monthly income. For the top 1% of earners, the math enters a discretionary zone. This is where judges apply the three-pony rule. The idea that no matter how much a parent earns, a child only needs so much, and the court won't order enough support to buy 3 ponies. However, in 2026, the math is shifting toward a lifestyle maintenance formula. If a child was raised flying private and attending $60,000 a year prep schools, the support math must reflect that reality to maintain the status quo. Imagine if Michael was a professional athlete or a tech founder. The insurer would use a high-cap risk model, because the potential support payments could reach $15,000 or $20,000 a month. The premium for a support indemnity policy would be astronomical. These policies often include a disability bridge. If Michael's income suddenly drops, due to an injury or a market crash, the insurance pays the child support obligation for a set period, preventing him from falling into legal contempt while he petitions the court for a downward modification. This is a critical mathematical safety net, as child support arrears in the U.S. often carry a mandatory interest rate, sometimes as high as 10% to 12% annually, creating a debt spiral that is almost impossible to exit. Now, consider the mathematics of the second family. This is a complex variable known as the multifamily adjustment. If Michael remarries and has a new child, does his obligation to his first child decrease? In many states, the math says no. The first child has a first-in-time priority. However, some jurisdictions allow for a credit for other children. The actuary must calculate the dilution of income. If Michael now supports 4 children instead of 1, his marginal propensity to consume changes. Divorce insurance products for high-net-worth individuals often include a successive marriage rider, which hedges against the cumulative financial weight of multiple support orders. Step by step, the adjustment works like this. First, the court calculates Michael's gross income. Second, it subtracts a predetermined amount for the support of his newer children, but only if he is legally obligated to support them. Third, the remaining income is used to calculate the support for the first child. This creates a priority queue of capital. In 2026, wealth managers use Monte Carlo simulations to show clients how a second or third divorce would mathematically impact their retirement age. Usually, the simulation shows that each successive divorce pushes the work until date back by an average of 4.7 years. But the most sophisticated math in the nursery is the valuation of the tax credits and exemptions. Following the tax law shifts leading into 2026, the head of household filing status and the child tax credit have become major bargaining chips. Because these credits have a phase-out range based on adjusted gross income, they are worth more to Elena than they are to Michael if Michael is in a higher bracket. A forensic accountant will perform a tax neutrality swap. They might suggest that Michael pays an extra $200 a month in support if Elena allows him to claim the child as a dependent, because the tax savings for Michael are $5,000, while the cost to Elena is only $2,000. It is a mathematical arbitrage where both parents can theoretically come out ahead by exploiting the inefficiencies of the tax code. However, even the most perfect support formula cannot account for the volatility of the future. What happens if the inflation rate for college tuition continues to outpace the consumer price index? Most child support orders end at age 18 or 19, but the true financial cliff is higher education. In the next part, we are going to dive into the mathematics of post-secondary support and the 529 plan litigation. We will look at how the educational obligation is being codified into insurance products, and how the expected family contribution formula from the FAFSA is being used as a weapon in divorce negotiations. We are moving from the nursery to the university, and the numbers are about to get 6 figures deeper. If you think child support is expensive, wait until you see the math of a 10-year tuition hedge. The transition from basic child support to the mathematics of higher education is where many middle-class and high-net-worth families encounter their most significant, unfunded liability. In the United States in 2026, The cost of a 4-year degree at a private institution is trending toward $400,000, while top-tier public universities for out-of-state students are approaching $250,000. When a marriage dissolves, the question of who pays for college is not just a moral debate. It is a complex calculation of the tuition inflation rate against the projected yield of marital assets. To model this, we use a post-secondary hedge. Imagine a couple, Chloe and Daniel, divorcing in 2026 when their daughter, Maya, is 8 years old. In many states like Illinois or New Jersey, the court has the statutory authority to order divorced parents to contribute to college expenses, even after the child has reached the age of majority. This is the educational support obligation. To quantify this risk, an actuary calculates the future value of tuition. If tuition is $60,000 today and is inflating at 5% annually, the cost when Maya turns 18 will be approximately $97,733 for her freshman year alone. The total 4-year cost is projected to be nearly $413,000. In a divorce settlement, this is often handled through the segregation of a 529 college savings plan. However, the math of a 529 plan in a divorce contains a hidden trap: the ownership variable. If Daniel is the account owner, the assets are technically his. If he remarries and has more children, or if his relationship with Maya deteriorates, he could mathematically reallocate those funds, or simply suffer the 10% penalty to liquidate the account for himself. To mitigate this, 2026 divorce insurance products include a tuition trust indemnity. This policy ensures that the agreed-upon educational funding is locked into an irrevocable structure, where the math is protected from the behavioral volatility of the parents. Let us look at the step-by-step details of the expected family contribution, or EFC, which has been rebranded in recent years as the Student Aid Index, or SAI. When Maya applies for financial aid, the federal government's formula looks at the income of the custodial parent, the one who provides the most financial support. In 2026, the math of aid eligibility has become a tactical weapon. If Chloe earns $50,000 and Daniel earns $300,000, Maya's SAI will be drastically different depending on which parent is designated as the primary provider in the divorce decree. A tactical divorce decree might be written to designate Chloe as the custodial parent for financial aid purposes, even if they share 50-50 custody. This moves Maya's SAI from a high-bracket no-aid category to a high-need category, potentially unlocking tens of thousands of dollars in institutional grants. However, insurers look at this as a regulatory risk. If the Department of Education changes the formula to look at both parents' incomes regardless of custody, a trend already gaining momentum, the financial aid package could vanish. A college cost insurance policy acts as a gap filler for this specific scenario. If the aid package fails to materialize due to a change in federal law, the insurance pays the difference between the projected SAI and the actual cost. Furthermore, we must analyze the mathematics of the 529 plan clawback. In high-net-worth divorces, if one spouse contributed $150,000 to a 529 plan just before filing for divorce, the other spouse's forensic accountant might argue this was a dissipation of marital assets. The math used to prove this is the historical contribution mean. If the couple typically contributed $5,000 a year and suddenly jumped to $150,000, the anomaly detection algorithm flags it. The court may then add back that money to the marital pot for the purpose of division. This creates a circular math problem where the money intended for education is consumed by the legal fees required to argue about it. Step by step, the valuation of an educational obligation in 2026 follows this sequence. First, the actuary determines the agreed standard of education. Is it the cost of a state school or an Ivy League? Second, they apply a discount rate to find the present value of those future tuition payments. If the future cost is $400,000 and the discount rate is 4%, the couple needs to set aside approximately $270,000 today. Third, they determine the funding ratio. If Chloe provides 40% of the marital labor and Daniel provides 60% of the income, the funding of the college account is split according to their relative economic power at the time of dissolution. Consider the scenario analysis. For a student like Maya, if she chooses a degree with a high return on investment, such as aerospace engineering, the parents might view the tuition as a capital investment. If she chooses a degree with a lower projected income, the insurance policy might include a downside protection rider. This is a fascinating new concept in 2026 where the insurance pays out if the student's post-graduation salary falls below a certain percentile of the tuition cost. This essentially ensures the utility of the education itself within the context of the divorce settlement. We also have to look at the graduate school contingency. Historical trends show that more students are pursuing master's and doctoral degrees than ever before. In a divorce decree, the math often stops at the age of emancipation, which is typically 21 or 23 for students. However, for a family in the top 5%, the status quo often includes funding for law or medical school. Insurers calculate the probability of professional pursuit. If both parents are doctors, the actuary assigns a 65% probability that the child will also pursue a graduate degree. The premium for advanced degree indemnity is priced accordingly, creating a life cycle fund that outlasts the divorce process by a decade. But what happens when the math of the university meets the math of the estate? In many cases, grandparents are the primary funders of 529 plans. In 2026, the grandparent-owned 529 has become a major point of third-party risk. If the grandparents side with one spouse during the divorce, they can effectively defund the child of the other spouse. To solve this, sophisticated divorce settlements now include joinder agreements for grandparents, mathematically tying their 529 contributions to the divorce decree. This prevents the intergenerational weaponization of education funds. The complexity of these educational hedges is only a precursor to the ultimate mathematical challenge: the division of the business. Most American wealth is not held in 529 plans or bank accounts. It is held in private companies, professional practices, and family-owned enterprises. When a business owner divorces, the math transitions from budgeting for tuition to determining the terminal value of a life's work. In the next part, we are going to dive into the mathematics of business valuation. We will look at the double diamond method of valuing goodwill and how the key man discount can be used to protect a company from being liquidated in a divorce. We are moving from the campus to the boardroom, where a single decimal point can shift a settlement by millions. The real audit is just beginning. The boardroom is where the abstract concept of marital partnership meets the concrete reality of corporate governance. In the United States, small to mid-sized businesses represent the vast majority of private wealth, and when the owner of such a business divorces, the mathematical challenge is to value an asset that is often inseparable from the owner's own identity. This brings us to the most controversial calculation in forensic accounting: the valuation of professional goodwill. Imagine a character named Thomas, who owns a successful architectural firm in Seattle. In 2026, Thomas is going through a divorce with his spouse Linda. The business is the primary asset. To value this, we must use the capitalization of earnings method, but with a specific focus on the enterprise versus personal goodwill split. Personal goodwill is the value associated with Thomas's specific reputation, his unique relationships with clients, and his specialized skills. Enterprise goodwill is the value that would remain if Thomas walked away tomorrow: the brand, the systems, and the staff. In many jurisdictions, personal goodwill is considered separate property and is not subject to division, while enterprise goodwill is a marital asset. To solve for this, actuaries use the multi-attribute utility model, or MAUM. This involves a step-by-step scoring of various business attributes. For example, if Thomas's firm is named Thomas Architect Group, the personal name association increases the personal goodwill score. If 80% of the clients come specifically to speak with Thomas, that further skews the math. The goal for Thomas is to maximize the personal goodwill percentage to protect the business from liquidation, while Linda's legal team will argue for a high enterprise value. Next, we must analyze the key man discount. In the context of divorce insurance and business valuation, this is a mathematical adjustment that accounts for the risk of the business losing its primary driver. If the court orders Thomas to sell the firm to pay Linda her half of the marital estate, the market value of that firm drops significantly because Thomas is no longer at the helm. This is the liquidity discount. Historical trends show that a forced sale in a divorce context can result in a 30 to 50% loss in realized value, compared to a strategic, planned exit. Insurance products in 2026, known as business continuity marital riders, are designed to prevent this. These policies provide the non-owning spouse with a cash settlement funded by the insurance company, allowing the business owner to retain 100% ownership of the company without having to sell assets or take on massive debt to buy out their ex-spouse. Let us look at a case study of a buy-sell agreement triggered by divorce. Imagine Thomas has two business partners. Their corporate bylaws likely include a clause stating that if any partner divorces, the company or the other partners have the right to buy out the spouse's interest at a predetermined formulaic price. The math of this formula is critical. It often uses a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. If the multiple is set at 4.0, but the actual market multiple for architectural firms in 2026 is 6.0, the spouse is being mathematically squeezed. Insurance companies now offer fair market value gap insurance, which pays the spouse the difference between the restricted buy-sell price and the actual appraised value, ensuring the business remains stable while the spouse is made whole. Furthermore, we must explore the mathematics of the double dip in business income. This occurs when the business's income is used once to value the business as an asset and a second time to determine Thomas's ability to pay alimony. To avoid this, forensic accountants use the excess earnings method. First, they determine a fair market salary for Thomas, what it would cost to hire a CEO to do his job. Then, they subtract that salary from the business profits. Only the remaining excess earnings are capitalized to determine the business value. This ensures that the same dollar is not counted as both property and income, a mathematical error that has historically led to the financial ruin of many small business owners. Step by step, the valuation process follows a rigid hierarchy. First is the normalization of financial statements. Thomas might be running his personal car lease, family vacations, and home office expenses through the business. These are add-backs. If his firm reported $500,000 in profit but had $150,000 in personal perks, the math dictates the true profit is $650,000. Second is the selection of the cap rate. The capitalization rate is the inverse of the multiple. If the risk of the industry is high, the cap rate is higher, which makes the business value lower. In 2026, with the rapid integration of AI in architecture, Thomas might argue for a higher risk cap rate, suggesting his business model is under threat. This leads to the valuation of intellectual property and future royalties. If Thomas's firm has a proprietary software tool for sustainable building, the math moves into the relief from royalty method. This calculates what the firm would have to pay to license that software if they didn't own it. The present value of those saved royalties over a 10-year horizon is added to the business's valuation. For a tech-heavy firm, the IP can often be worth more than the physical assets and the client list combined. But what if the business isn't a firm but a brand? In the age of social media and digital influence, the mathematics of personal branding in divorce is a frontier. If Linda assisted Thomas in building his professional brand, managing his social media, editing his white papers, or organizing his speaking tours, she may have a claim to a percentage of his future earnings under the theory of enhanced earning capacity. The math involves calculating the career asset value. This is the difference between Thomas's projected lifetime earnings with the brand and his projected earnings without it. Historical trends in states like New York previously recognized professional licenses as marital property, and while that specific law has evolved, the mathematical principle of valuing a person as a business entity remains a core part of 2026 settlements. Consider the scenario of a negative equity business. If Thomas's firm is struggling and has more debt than assets, the math changes to a liability allocation problem. In a divorce, you don't just divide the gold, you divide the lead. If the business has a $1 million line of credit that Thomas personally guaranteed during the marriage, Linda might be mathematically responsible for half of that debt. This is where divorce debt insurance comes into play. These policies protect the non-owning spouse from being dragged into a bankruptcy caused by the other spouse's business failures post-divorce. It effectively severs the financial umbilical cord that remains even after the legal papers are signed. The boardrooms of America are filled with these mathematical landmines. A single miscalculation of a minority discount, a reduction in value because a spouse owns less than 50% of a company and therefore lacks control, can result in a swing of millions of dollars. As we move into the next part of this masterclass, we are going to look at the mathematics of the alimony buyout. We will see how to calculate the lump sum present value of a lifetime of payments and why taking the cash today is often a massive mathematical gamble against the rate of inflation and your own life expectancy. We are moving from the assets you own to the income you owe. The calculation of forever is about to begin. The calculation of forever in the American legal system is technically known as spousal maintenance or alimony, and in 2026, it has been distilled into a brutal series of present value formulas. When a court determines that one spouse owes the other a monthly stream of income for a set duration, the payer often asks a critical mathematical question. Can I just pay a lump sum today and be done with it? This is the alimony buyout, and it is a high-stakes game of actuarial poker. To solve this, we use the discounted cash flow model. Imagine a character named Christopher, a senior executive at a logistics firm in Chicago, who is divorcing his spouse, Patricia, after 24 years of marriage. The court determines that Christopher owes Patricia $8,000 a month for 10 years. On the surface, that looks like a $960,000 obligation. But $8,000 10 years from now is not worth $8,000 today due to the time value of money. To calculate the buyout, an actuary must select a discount rate. If the actuary uses a conservative 4% discount rate, the present value of that $1 million obligation drops to approximately $790,000. If they use a more aggressive 7% rate, reflecting potential market returns, the buyout price falls further. This leads to the mathematics of inflation risk. If Patricia accepts the $790,000 today, she assumes all the risk that inflation will erode her purchasing power. If the consumer price index spikes by 5% annually over the next decade, her fixed monthly equivalent will buy significantly less in year 10 than it does in year 1. Conversely, if Christopher pays the monthly amount, he bears the risk. In 2026, alimony indemnity insurance has emerged to solve this specific friction. A payer can purchase a policy that adjusts the payments for inflation, or a payee can purchase a policy that protects against the payer's default. Step by step, the math of an alimony default is terrifying. In many states, alimony is non-dischargeable in bankruptcy. If Christopher loses his job and stops paying, the arrears accrue at a statutory interest rate. In Illinois, for example, the interest on a judgment is 9% simple interest per year. If Christopher falls behind by $100,000, he doesn't just owe the principal. He owes $9,000 in interest every single year he remains in default. This creates a mathematical debt trap. Divorce insurance products in 2026 often include an alimony bridge rider. If the payer is laid off, the insurance company covers the alimony payments for up to 12 months, preventing the interest clock from starting and keeping the payer out of legal contempt. We must also analyze the cohabitation and remarriage termination clauses. Most alimony orders state that payments end if the recipient remarries or cohabitates with a new partner in a relationship equivalent to marriage. For an insurer, this is a termination probability problem. Actuaries look at historical trends of remarriage rates by age and gender. For a woman in Patricia's demographic, the probability of remarriage within 5 years might be 30%. This probability is baked into the buyout math. If Christopher pays the lump sum, he loses the chance that the payments would have ended early because Patricia remarried. He is essentially paying for a 100% probability of a 30% risk. But what about the tax implications? Following the Tax Cuts and Jobs Act of 2017, which remains the baseline for our 2026 calculations, alimony is no longer tax-deductible for the payer and is no longer taxable income for the recipient for any decree signed after 2018. This shifted the mathematical burden entirely onto the higher earner. Before this change, Christopher would have been paying with pre-tax dollars. Now he must earn roughly $13,000 to send Patricia $8,000, assuming a 40% effective tax bracket. This is a 62% tax loading. The math of the buyout must reflect this. When Patricia receives a $790,000 buyout, she is receiving it tax-free. To Christopher, that $790,000 represents over $1.3 million in gross earnings. Then there is the mortality risk. What happens if Christopher dies in year 3 of a 10-year obligation? Without protection, Patricia's income stream vanishes. To solve this, the court almost always requires the payer to maintain a life insurance policy with the ex-spouse as the beneficiary. The amount of insurance must be equal to the total remaining obligation. In 2026, we call this the declining term requirement. As Christopher makes payments, the amount of life insurance he is required to carry decreases. However, the math of the premium is not static. As Christopher ages, the cost per $1,000 of coverage increases. An actuary must calculate the crossover point where the cost of the insurance exceeds the benefit of the protection. Consider the case of the Social Security offset. For long-term marriages of over 10 years, a divorced spouse is entitled to claim Social Security benefits based on their ex-spouse's earnings record, provided they are at least 62 and unmarried. This does not reduce the payer's benefit. It is a mathematical free lunch provided by the federal government. In 2026, Sophisticated divorce planners use this to lower the alimony burden. If Patricia is 60 years old, they might structure a step-down alimony plan. The payments remain high for 2 years, and then decrease the moment she becomes eligible for her divorced spouse's Social Security benefit. This is the integration of private and public annuities. There is also the volatility of the lifestyle analysis in alimony. In high-stakes cases, the math revolves around the marital standard of living. Forensic accountants create a lifestyle spreadsheet that accounts for every cent spent during the final 3 years of the marriage. They then apply a household size adjustment. It is mathematically proven that a single person needs approximately 60 to 70% of what a couple needs to maintain the same standard of living. If the marital household spent $20,000 a month, Patricia doesn't need $10,000. She needs $14,000. This 70% rule is the baseline for many 2026 insurance underwriters when determining the appropriate level of coverage for a maintenance policy. Finally, we have to look at the retirement gap. If Christopher is 55 and Patricia is 55, and Christopher retires at 65, the alimony usually ends. But Patricia has missed out on 10 years of compounding her own retirement accounts because she was out of the workforce. The math of the alimony to retirement transition is where many settlements fail. Modern insurance products now offer an annuity conversion option. At the end of the alimony term, the policyholder can convert the remaining death benefit or a portion of the premiums into a lifetime annuity, ensuring that the end of alimony isn't a financial cliff. We have now covered the assets, the businesses, the children, and the income. But there is one final piece of the puzzle that governs all the others: the mathematics of the final negotiation. In the concluding part of this masterclass, we are going to dive into game theory. We will look at the Nash equilibrium in divorce settlements and how loss aversion dictates why most cases settle on the courthouse steps. We will reveal the settlement curve and show you exactly when the math says you should stop fighting and start signing. The final 10% of the journey is where the most money is made or lost. We are going to show you how to close the loop. The final 10% of any divorce is governed by a mathematical phenomenon known as the war of attrition. In game theory, this is a model where two players compete for a resource by persisting at a constant cost. The winner is the one who lasts longer. But the paradox is that the cost of competing often exceeds the value of the prize itself. In the United States in 2026, the average contested divorce takes 12 to 18 months to resolve, and during that time, the legal fees act as a negative interest rate on the marital estate. To navigate this, we must apply the Nash equilibrium, the point where neither spouse can improve their outcome by changing their strategy unilaterally. Imagine a character named Jennifer, a surgeon in Los Angeles, and her spouse, Kevin. They are fighting over a vacation property worth $500,000. Each month they continue to litigate. They spend a combined $15,000 in legal fees and expert costs. Mathematically, if they resolve the dispute in month 1, they split $500,000. If they fight for 2 years, they have spent $360,000 to decide who gets the remaining $140,000. The math of the settlement curve suggests that there is a point of diminishing returns, typically reached around the 9th month of litigation, where every dollar spent on a lawyer has a less than 10% chance of returning a dollar in a settlement. This is why 95% of cases in the US settle before trial. The math eventually forces a rational conclusion. One of the most powerful tools used by insurance companies and high-stakes negotiators to close the loop is the BATNA, the best alternative to a negotiated agreement. To calculate your BATNA, you must use a probability-weighted expected value. If Jennifer goes to trial, she has a 60% chance of winning the house and a 40% chance of losing it. However, the trial will cost $50,000 in non-refundable fees. Her expected value is not $500,000. It is $500,000 multiplied by 0.6 minus $50,000, which equals $250,000. If Kevin offers her $260,000 to settle today, the math says she should take it, even though she feels she is right. Accepting a lower certain value over a higher uncertain value is the core of risk aversion math. This brings us to the concept of loss aversion, a principle of behavioral economics that states the pain of losing is twice as powerful as the joy of gaining. In divorce negotiations, spouses often focus on what they are losing rather than what they are retaining. An insurer's settlement algorithm counters this by reframing the math into a gain frame. Instead of looking at the $250,000 Jennifer is giving up, the math highlights the $15,000 a month in cash flow she is saving by ending the conflict. In 2026, we see the rise of settlement incentive insurance. This is a policy taken out by one spouse that pays a bonus to the other spouse if they settle within a specific time frame, say 180 days. It is a mathematical bribe designed to stop the bleeding of the marital estate. Step by step, the final negotiation follows the sunk cost fallacy trap. Jennifer might say, "I have already spent $100,000, I can't stop now." But the math of the future does not care about the money already spent. The only variables that matter are the future cost of litigation and the marginal utility of the next $1. If winning an extra $10,000 in alimony requires spending $12,000 in forensic accounting fees to prove the other spouse's income, the math is a net negative. Forensic accountants use a net benefit analysis to show clients exactly when to walk away. They plot the cost of each legal motion against the statistical probability of that motion changing the final decree. We must also analyze the final offer arbitration model, sometimes called baseball arbitration. In this mathematical structure, both Jennifer and Kevin submit their final, best offer to a private judge. The judge must pick one of the two offers. They cannot create a middle ground. This forces both parties toward the center. If Jennifer's offer is too greedy, the judge will mathematically gravitate toward Kevin's more reasonable offer. This effectively eliminates the extreme outliers that plague traditional litigation. Insurance companies often require this type of arbitration in their policy language to cap their exposure to irrational behavior. Furthermore, consider the mathematics of the emotional premium. In 2026, we have identified a measurable cost to the psychological stress of divorce, often reflected in a 15% drop in professional productivity for high earners. If Jennifer earns $600,000 a year of litigation costs her $90,000 in lost focus and missed career opportunities. This is the hidden delta. When you add the $180,000 in legal fees to the $90,000 in lost productivity, the real cost of the divorce is $270,000 before a single asset is even divided. This is why the math of divorce insurance is shifting toward pre-litigation defense. Some policies now provide a cash payout for mental health support and executive coaching during the first 90 days of a filing, mathematically betting that a healthier mind will reach a faster, cheaper settlement. Historical trends in 2026 show that the most successful settlements are those that utilize a structured payout. Instead of a one-time transfer of $1 million, the math might favor a 5-year private annuity. This allows the payer to keep the capital working in the market, while providing the payee with a steady, predictable income stream. The math of the internal rate of return or IRR for both parties can be optimized by stretching out the payments. This is the final step in closing the loop, moving from a battle over a static pie to a cooperative management of a shrinking pool of resources. As we conclude this deep dive, we have to look at the global context. The United States is the largest market for these mathematical domestic products, but the principles of divorce insurance and domestic risk management are spreading. We are seeing the emergence of transnational marital hedges for couples with assets in multiple countries. The math there involves currency risk, jurisdictional arbitrage, and the Hague Convention. The story of divorce in America is no longer just a story of law and emotion. It is a story of data. We have moved from the subjective he said she said to the objective the algorithm said. While the mathematics of heartbreak can feel cold, it provides a level of clarity that the legal system historically lacked. By quantifying the risk, we allow families to hedge against the catastrophe of dissolution. We have looked at the actuarial tables of the nursery, the tax-efficient boardrooms, the forensic hunts for hidden millions, and the game theory of the final signature. But even with all the math in the world, there is one variable that no actuary can truly account for: the black swan. A black swan is an unpredictable event with massive consequences. In a divorce, this could be a sudden change in state law, a total market collapse, or a personal health crisis. In the next chapter of American Finance, we will see how these models adapt to a world of increasing volatility. For now, the loop is closed, the assets are divided, and the math has reached its equilibrium. The next time you see a marriage license, remember that you aren't just looking at a romantic gesture. You are looking at a complex, high-stakes financial derivative with a 50% chance of execution. This has been the masterclass on the mathematics of the American divorce. Knowledge is the only insurance that never expires.